Welcome back to Basic Business Training 2, and we are glad that you could join us for this next session. The last session we began talking about money management and the difference between bookkeeping and accounting. And we're going to go a little bit deeper into that in this session. We're going to be looking at the accounting equation. And normally when I am teaching with people in person and people are in the classroom, I usually say that this often is a session where people's bodies remain in the room, but their minds leave very quickly. And so people are looking at me, and they may even be smiling, but I can tell that they are far away. And I hope that you don't do that. I hope that you stay engaged and that you recognize that this is a good opportunity to really help your business to grow and to really understand what is going on in your business from this very important aspect. I know that sometimes there is a spiritual aspect that we put onto finances, and we want to say we just need to trust God. We don't really need a budget. We just need to trust God. And I want to say that part of trusting God is being trustworthy as well, and therefore this is part of how you are handling what God has given you. And so it's not a matter of not being spiritual. It's a matter of being actually more spiritual, because you are saying, God, you have blessed me, and I want to be a blessing, and I want to see this world flourish, and I want my family and myself to flourish, and I want to hire more people and get more jobs out there so that more people can flourish and continue to produce the good things that I'm doing so that more customers can flourish. So this is not about saying we just need to let go and let God, but actually it's a way that we say we let God by making sure that we are presenting to Him what is His, and we are accountable for what He has given to us. So with that, let's get into some of the details of accounting. There's three main activities in accounting, and the first is, of course, identification. We want to identify those things that are happening that we need to capture as it relates to finances. There are lots of activities going on in your business, and we need to make sure that we know which ones we want to fully capture. The second then is, after we identify, we have to record. And we talked the last time about needing to set up a system for how to record. And we'll go through some of that today in this session as well. And the third then is communication. And so once we record it, we have to be able to communicate. What are the things that are happening? And last time we talked about a financial planning process that was plan, do, and review. And this is somewhat similar to that. We need to identify, record, and then communicate. And those are ways that we have to continue to think about for the accounting system in general. And so as it relates to communication and reports, there's two main documents that we want to cover in this session and in the next as it relates to coming up with some realizations about the money flowing in and out. The first is called an income statement. You may have heard people refer to it as a profit and loss statement or a P&L. All of those are the same thing. It's an income statement, and if you think about the term, it's a statement about the income of the business. And so usually it happens over the course of a month. And it's capturing all the money coming in and money flowing out for that period of time. And so there's a portion on your income statement, and we will go through it, that identifies the income, and a portion that identifies all the costs. And it's usually done over a period of time. A balance sheet is the second report that we want to do, and a balance sheet relates to the business's total value, what it's worth. And a balance sheet is usually done on a particular day, and it doesn't cover a period of time because you evaluate the business at a specific point in time. And I like to say that a balance sheet is kind of like a cumulative snapshot, If I take a picture of you and you are an adult, I am taking a picture of you in a particular date and time as an adult, but one of the things I am seeing is all of the components of who you are from the time you are a baby, toddler, teenager to an adult. It's a accumulation of you as a whole person. A balance sheet is taking a picture of your business, and it's trying to assess everything that has gone on in this business from the time it started until where it is today. But we do it at a specific point in time. And so a balance sheet will tell us about all the assets that the business owns. An income statement does not do that. A balance sheet will tell us all about the liabilities, the people that we owe money to. An income statement does not do that. And a balance sheet also tells us how much the owner has equity, how much of the business is owned by the owner, and that is also on the balance sheet. And the income statement doesn't do that. And so the income statement is just money coming in and out over a period of time. A balance sheet is showing us the whole picture of the whole business and where all these things came from that the business has, and it tells a story in that way. And so as we start getting into the details, I want to just say this, and for any of you who are accountants out there, if you could just plug your ears for a second, I'm going to say that there's no official right way to organize your books. There are accountants and the standards of accounting, and God bless them, they do an amazing, wonderful job. But for you and I, that may be a little bit too complicated, and we want to keep this simple. And so there are some things that we can do to help us get on that path. There's two things, again, that I will keep saying that we do. We track money coming in and money going out. But as your system grows, and our prayer is that your business will grow and will become more profitable and sustainable, as you grow and the business grows, that system will have to become more complicated and more sophisticated. And so there are ways that you can keep your books, and we will just be going over a few things. But if you're at the very beginning and you're still a little nervous about how to start, I have a recommendation for you to just start very simple in terms of beginning to keep track of where money is coming in and going out. So if you do these things, you're already halfway to a good bookkeeping system. If you buy something but you don't pay for it right away, ask the person to give you an invoice. When you get back to your business, or if your business is in your home, wherever you have a desk or a table, I would ask you to get 4 shoe boxes. And on one of the shoe boxes, you put the word invoice, to be paid. And that invoice that you just received, you put it in there. Done. The next thing is when you pay cash for something, ask the person for a receipt. And then you go back in that second shoebox, you put the word receipts in, and you put the receipt in there, and now you've captured that. The third thing, if you sell something and the person doesn't pay you right away, give them an invoice. And now in your third shoebox, you have invoices to be collected, and you put the copy of the invoice in there, and you know that that is the box of people who owe you money. And finally, when somebody pays you cash, you give them a receipt, and you put the copy in that final receipt is receipts from customers. And so those are the 4 boxes that you want to have. And what you're doing is you're just beginning to create a track record. So even if you're not ready to look at those and to organize them into some different ledgers, at least you can even give the boxes to somebody and say, here, help me organize this. I've got all the information. I've been keeping track of things, and now I need help putting a system together. And there's a lot of people that can help you put the system together. They can mentor you. And our hope at the end of this class is you will begin mentoring each other. They will mentor you on how to do it, and you will see that it's not that difficult. Sometimes fear keeps us from doing things that are really not that difficult, and once we get over the fear, we develop the habit, we are able to make it happen. And so if you remember in Basic Business Training 1, we presented a worksheet for you, and there will be one in your workbook as well that we want to just review because it's going to lead into how we do an income statement and a balance sheet. And so look in your workbook at that worksheet that has the different boxes for the different things that we are spending money on. And if you remember, at the top of that, we have our working capital. And so if you are restarting this process over and you want to use this particular system, you're not using another system already, if you're using another system and it's working for you, that's great. Don't change it. We're not saying that this is a better system. This is a system. And so at the top of this worksheet, you want to enter in how much working capital do you have? And essentially we're asking how much cash does the business have? In the bank, in the shop itself, under your mattress, whatever, if it belongs to the business. if it's in a savings club, if it's in a merry-go-round, whatever you might be using that has business money, what is the total amount of money that the business has? And write that in the top box. And then for the next 7 days, or however many days you're open, you begin to record how much cash is coming in, and that goes in that first box there. If you're selling, if you have a pharmacy and you're selling multiple drugs, of course you're not going to be able to provide a description. Hopefully you have a different ledger that does that, so you know for your inventory what you need to order. But in this case, and in this scenario, you would just put in the amount of sales that you would have on a given day. So the date and the amount of income that came in. And so at the end of the week, you are adding up how much total income has come into the business. Now, one thing that I have seen can be a problem sometimes is that we have income that comes in, and then we use some of that income for an expense. And so what I've seen some people do is that at the beginning of the day, they look at the cash that they have, and let's say we have $100. And by the end of the day, we look at the cash and we have $150. And so we say we made $50 in income. And that's how we're tracking it. But we forgot that we actually gave some of that cash away to do this job or to do that job, and so we're not keeping an accurate record. And so that is why we need to have paper trails for these things, so that we can have a good assessment of how much actual income we are making, and we would recommend that cash remains untouched, at least for that day. And if you have a petty cash drawer, it is something that you keep in a different place so that you can record money that is going out and be able to track that. I hope that makes sense. As you go through your day, your week after you are recording your income, that is where you begin to record your variable cost. And so variable costs, if you remember, those are the things that you spend money on that the customer actually takes with them. So let's say you are baking bread. Of course, the customer is taking away the flour and the salt and the yeast and the oil and other things that you might put into the bread. They are also taking not just the raw dough away, it's baked, and so they're taking away the fire or whatever you use to bake it, and maybe a plastic bag, and that's what the customer takes with them. And so that is a variable cost because your costs vary based upon the amount of sales that you have. And so maybe you don't buy things every day. I'm hoping that you don't. It might not be the most efficient way to do things if you're buying your inventory every day. Some of you may have very fresh products like fresh vegetables, and so you might need to do that. But you want to record in there, what did I buy for my variable costs throughout this week? On the next box, you then want to start recording what you put aside for your fixed cost. And those were things that you had to pay for regardless of sales. So for example, if you pay somebody a salary, it doesn't matter whether you had sales or not, you have to pay the salary. Maybe you paid your utilities. It doesn't matter. The utility company doesn't care whether or not you had sales. They expect you to pay what you used in terms of electricity or in water. And so that's why it's called a fixed cost. It's something that doesn't vary based on sales. It's something that you have to pay no matter what. And so in that third box is where you'll be recording your fixed costs and what you spent during the course of that week for those areas. And then the next one, the last box there at the bottom, is cash that has gone out of the business, but it wasn't for variable cost and it wasn't for fixed cost. And so these would be other types of circumstances, like maybe you bought a new piece of equipment for the business. That is not something the customer takes with them. It's also not something that you do on a regular basis, so it actually doesn't show up in the income statement. It shows up on the balance sheet. You have taken an asset that you have, and we'll talk more about that soon, the cash that you had, and you bought a machine, and so you transferred cash into another good thing, a piece of equipment, and so that goes in that bottom box. At the bottom now of your box, you are going to be adding up the money you started with plus the income that you made, and then you will be subtracting the last three boxes, the variable cost, the fixed cost, and then the other items that you may have purchased. And then if you remember what we talked about the last time we went over this, is on the right side now is where you begin doing the planning. And so we've been recording all of the doing, and now we need to do some planning for the cash that we have now that we are finished with this week. And if you remember, when we do this, we want to end up with zero. We want to allocate. We want to plan for that money to go somewhere, because unplanned money finds a way to leak out, and you just can't account for it. You are not able to be a good steward of that because it will leak. I mean, our pockets have holes, not literally, but it sure feels like it might be literally sometimes, because money just goes out. And so on the right side of this document, you want to say, how much money do we have to set aside for this next week? We want to write that down. And then if you don't have a great bookkeeping system, maybe you want to take some envelopes, and this is your working capital envelope, and you put the cash in there so that it already is gone. In your mind, it's gone. That's for the business. That's what we need to keep the business running. What do we need to for a loan payment? Maybe we have a loan that is coming up, and every week we want to put away 1/4 of that. And so you take the next envelope that says loan, and you take the amount that you can put in for that and put it in the envelope. And again, you don't touch that until it's time to pay that loan. The third one then is the owner's draw. You as the owner, you don't take a salary. If you remember, we talked about the fact that you have to be more flexible. If the business isn't doing well, it's not going to be good for the business for you to take a salary. On the other hand, if the business is doing great, you can take more than the salary, the amount of money that you believe the business can afford to pay you, and you can go above that, because as the owner, that is your right to do. And so you have another envelope that's for the owner's draw, or maybe some people would say that is their spouse that they want to go and give that money to and say, this is for us for this week. The next one there is business goals, or maybe you want to reinvest in the business. And our encouragement is that you really keep that business growing. And so you want to take that money, you want to say, I'm going to put this is going to be like my savings for the next piece of equipment, because I don't want to take a loan for that. And then, of course, the last one there, or the second last one, is savings. And we recommend that you have 3 months of your fixed costs for your business in savings, so that should an emergency happen, and we pray that does not happen, at least you can continue to pay the rent, you can continue to pay salaries, you won't lose the business, at least for 3 months, as you wait for whatever emergency it is to pass. Lastly, you may choose to set aside some of your wages, some of the profit for gifts. Some people do choose to have their business tithe, and what we often say is that you, as an individual tithe, you don't have to have your business tithe, but some people do that, and that's a good and beautiful thing if you can do that. Some people choose to give a certain amount away. It's called corporate social responsibility, and financially is one way that you can do that. You can also do it by giving of your time and your talents to other people. So that is also there. But the idea is that you go through these sections until you're able to spend that all and have an accounting of it. And then our goal is that you do this for 4 weeks. And so again, if you're using another system, that's great, as long as you can come up with what a month looks like. We are saying 4 weeks. We know that not every month, of course, has exactly 4 weeks. Very few do. Many have more. So you can modify those 4 to fully encompass 4 weeks. And then we want to take that and move it into an income statement and in a balance sheet. On the back side of that sheet, of course, you also have the accounts receivable, and that's money that people owe you. Somebody takes something on credit, that's called an account that you are expecting to receive. And so it's an accounts receivable, and that's a place where you can log that information to be able to track where some of your money is going. And I know that is actually a big leak for our profit. When we give people things on credit, and we want to trust them to pay it back, and we want to be kind, and we want to be generous, and we want to get more customers, and so we extend credit, and then they don't pay it back, it's 100% loss for the business. And so tracking it somehow, coming up with a policy, is very important. And then, of course, also the accounts payable. And so what you're seeing on the back side of this sheet are what we call non-cash transactions. Non-cash transactions are those transactions where you have a financial transaction, but the money hasn't actually moved. All right, so people take something and you extend it on credit. No cash has happened. And so on the other side of this sheet you are recording everything that happened in cash. On the back side is where you are recording things that were not cash. So people that owe you money, but then also people that you owe money, and that would be the accounts payable. This is called a cash system, and very soon we're going to be talking about a non-cash system, which is called an accrual system. And that is where we will be talking about how to record everything together, whether they are cash transactions or non-cash transactions. And so this page that you are looking at in your workbook, again, is one tool. But it is a critical tool that will help you to develop an income statement and a balance sheet. And this is why we call it a thatch roof, because it is only really capturing those cash transactions. And of course, if you are dealing with credit, either taking things on credit for yourself or extending credit, there can be a lot more that's going on with a business that is not captured. And if it's not captured well and recorded well, that can significantly impact the way a business is able to run. So if you're not doing anything, you can use this. Our encouragement will be, as you grow, that you begin to move towards a cash system, a recording system that I will be explaining to you through the basic accounting equation. All right, are you ready? Sit up, give yourself a stretch, let yourself shake your arms and get yourself ready, because we're going to start talking about the basic accounting equation, which I think is actually kind of fun. It can make a lot of sense, and it can really help you to understand your business better and how it works. And so the basic accounting equation is this. It is assets equals liability plus owner's equity. That's it. 3 things. Very simple. Assets equals liabilities plus owner's equity. And so I'm going to explain all of what these terms mean, but basically this provides the underlying framework for recording and summarizing economic events. And so we're going to talk about what are assets. And assets are those things that are claimed by the creditors and the owners. And if you think of the equation, what we are saying in a business is that assets are on the left side of the equation, right? So assets are explained by either the liability or by the owner's equity. And so what we're saying is, as you look at your business, there's only 2 ways that you came across those assets. You either got them because you have a loan, or you got them because of owner's equity. And we'll divide out owner's equity in just a minute. But what we want to say is, as you think about your business, there's an explanation for how you have what you have. And so assets are the resources that a business owns. They are cash, they are supplies, they are equipment, and so on. We say that we have liquid assets. We also have fixed assets. And so the liquid assets are those assets that we can very quickly turn into cash. And that would include the cash that you have, obviously. It would include your inventory, which you can sell. It would include the supplies that you have, and those types of things. Whereas your fixed assets, we're getting into things that are more difficult to sell quickly, but they are still something that the business owns. And that would include if you have a piece of land that the business owns. If you have a building on that land, that is a fixed asset. If you have a vehicle that the business owns, is a fixed asset. Any equipment that you are using, any machines that you are using are all fixed assets. So that is just a quick summary. We'll go into some more detail of that. But those are essentially the things that the business owns, that the business has, are assets. How do we explain these assets? As I said, liabilities is one way to explain it. And so liabilities are claims against the assets. And so maybe you have taken a loan. Maybe you don't own the land, but you have an agreement with the owner to pay off a certain amount. And so now we would see that the business has this piece of land, but how do we explain it? Well, we explain it that you have it because you have a loan out that you have to pay. It is whatever creditors that you have. And so that could include the long-term payments, such as a mortgage or such as a long-term loan. And we also have short-term liabilities, and those are things that we owe that usually take less than a year. Long-term liabilities are those that are for a year and beyond. And lastly, a last liability that we have to remember as well is those accounts payable that we were just talking about. Accounts payable are those things that are less than 30 days that we need to pay. And so it may be that you owe people salary when you are looking at a specific day, because today is the 20th of the month and we pay people on the 30th of the month, and so we still owe 20 days of salary. And so those are for less than 30 days. And so that's one way that we explain the assets that we have, the good things, the physical things that the business owns, is maybe we have a lot of loans. The last one then is if we don't have loans, and hopefully you don't have many loans, then we can explain it through the owner's equity. And owner's equity is basically the ownership claim on the total assets. And how do we get that? We get it in a way that if you look in your workbook, you will see how we break out owner's equity. And so what we are looking at with owner's equity is 4 different categories, usually. We start with the owner's capital. How much did you put into the business to start with? Because that is a claim that you have. That is how some of those assets got there, because you came into this business and you invested some of your own money. But just as we invest money, we also take money out, right? We talked about the owner's draw. And so the owner's capital is something that we add into this equation, but we have to subtract what we have taken out for our own income, for our own salary, for the draw that we were able to make. But then we want to add in the revenue that we have made, and this is often where we want to see the revenue from the time the business started till today. How much revenue has this business made since its beginning? And then we want to subtract from that the expenses, the costs that it's taken to run the business, and where that money has left and how. And so common sources of revenue, of course, are sales, our fees of services, commissions that you might charge, interest that you might be earning, dividends that you might receive, rent that the business might receive. Common expenses that we've looked at, of course, are salaries, rent, utilities, tax, and so on. And so all of that ends up being captured in the accounting equation. And it may sound like a lot to figure out, and I know when we're just talking about it, it can be difficult, but we're going to go through some examples together, and I'm hoping that that will help make it practical for what we are talking about. And so we want to ask the following questions just by way of illustration when we go back to what are the financial transactions that we want to record. And so are the following events recorded in accounting records? The first question is, supplies are purchased on account. And when we say on account, we mean that we have taken supplies, but we have not paid for them. We will pay them later for that. And so we want to think about these supplies. Now, supplies are an asset for the business, and so we go to a place and we say, I need these supplies for the business, and I'll pay you later. And so we come back and we take these things out and we put them in the business, and now the business has an asset of supplies. How do we explain that asset? Well, no financial transaction took place in terms of cash, but a financial transaction did take place in terms of a liability. Now we owe money for those supplies that we have. So our assets actually increased because now we have assets, and the way we explain those assets is because of a liability. We owe money. And so essentially what we're saying is, yes, we have these supplies, but we don't own them because the person we took them from has a claim against those assets. That's the first one. The second one, we hire an employee. Do we record that? Did a financial transaction take place? Did the financial position of the company change? And I hope that you're saying, no, it didn't, not just with hiring an employee, because all we did was extend the offer. They have not started working yet. And once they start working, then we will be incurring a transaction that we need to record for a salary that will need to be paid. The last one then is an owner withdraws cash for their personal use. Now, what happens with that is your assets. Remember, we said that cash is one of the assets. And so when you, as the owner, you go and you take money out for your owner's draw, your assets decrease, right? Your cash has gone down. How do we explain where that cash went? Well, now we have to go to the owner's equity and say that there was a withdrawal for the owner's draw. And so what you can see is that one transaction is typically recorded twice. You're typically seeing impacts happening on in two parts of the equation, not always on the left side, the asset side, not always on just the right side. In our example, we'll go through that and you will see, but it usually happens in two different places. And so for the example that we want to go through, the name of the company is SoftBite, and it's a new computer programming software business. It is run by a person whose name is Ray Neal. And what we hope to do in the next session is to go through the whole example of Ray Neal and for his business, SoftBite, and to get a chance to see this accounting equation in action. So what I'd like for you to do right now is just to repeat the equation with me, that assets equals liabilities plus owner's equity. Those will be words. As you are growing your financial accountability, those will be words that will be good for you to become familiar with. Assets equals liability plus owner's equity. And when we come back, we will introduce Ray Neal to you and his business called SoftBite. And I hope that this will shed a little bit more light on this as we move forward. Thank you so much for your time, and we will see you next time.